Good day and thank you for standing by. Welcome to the Centuria Office REIT FY21 results. At this time, all participants are in a listen-only mode. After the speaker's presentation, there will be a question and answer session. To ask a question during this session, you will need to press star one on your telephone. Please be advised that today's conference is being recorded. If you require any further assistance, please press star zero. I would now like to hand the conference over to your speaker today, to Mr. Grant Nichols. Thank you. Please go ahead.
Good morning and thank you for dialing in to the Centuria Office REIT 2021 financial results and fund update. I am Grant Nichols, COF's fund manager. FY21 has been a strong year during which COF delivered a record amount of leasing, FFO at the top end of the guidance range, and a significant amount of debt refinancing, which secures COF's future debt requirements. We believe this performance was made possible due to COF's geographically diversified portfolio of young, quality assets which offer good workforce commutability and attractive affordable rents, and exposure to Australia's better performing office markets. As Australia's largest pure play listed office REIT, we believe COF provides a quality, highly diversified portfolio leased to excellent tenant covenants. When combined with a solid weighted average lease expiry, an average building age of around 17 years, and ample undrawn debt and debt covenant headroom, COF remains well placed to continue delivering attractive income returns to unit holders. Earlier today, we published various documents on the ASX relating to the full year results, including a results presentation which we will go through this morning. Starting with the vision, strategy and objectives for COF on slide 3. Our focus for COF throughout FY21 has been and will continue to be generating predictable and quality income streams by building Australia's leading office REIT. Through active and engaged management, Centuria seek to further enhance the COF portfolio by taking advantage of the opportunities that come from having exposure to Australia's better performing office markets. Looking at this more practically on slide 4, we believe COF has been well positioned to first meet changing tenant demands and secondly, deliver COF's primary objective of sustainable quality income returns to our investors. Owning a geographically diversified portfolio without single market concentration enhances the sustainability of COF's income returns, as COF's largest single market exposure is Canberra at around 17%. Geographic diversification reduces risk to a specific market slowdown, or in the case of the current environment, specific market lockdown, while also allowing greater exposure to various industries contributing to the Australian economy's employment growth. Over the longer term, we believe there will be a strong employee preference towards working closer to home. For some time we've said a key contributor to employee satisfaction is the length and quality of their commute. This thinking has certainly influenced our decision to acquire buildings in locations like South Eveleigh and Fortitude Valley, with both providing excellent and improving connectivity. While there remains significant concern about productivity related to working from home, there is almost universal acceptance that the most efficient component of working from home is reduced time commuting to the workplace. Consequently, we believe businesses will more actively seek accommodation solutions that provide staff with workplaces close to their home, providing better commutability. This workplace change will directly benefit metropolitan and fringe office markets that COF is exposed to. We also believe, particularly in times when some markets have elevated vacancy, that there will be a flight to quality office accommodation. Some lazy industry bias may assume a flight to quality would see metropolitan and fringe tenants seek alternate CBD accommodation. While this may have happened in the past, current market data indicates the reverse. Over the past 6 months, we have seen positive net absorption in the Sydney fringe, Melbourne fringe and Brisbane fringe office markets, while each one of their CBD counterparts continue to incur negative net absorption. What this illustrates is a flight to quality accommodation in modern buildings outside of core CBD locations. In the medium term, we believe tenants will seek improved standards of accommodation and building amenity. As such, we believe there will be preference towards newer generation office stock, which should benefit the COF portfolio as the average building age is around 17 years. Affordability is always a key consideration for office tenants. Again, we believe COF is well placed, as the portfolio provides consistently high-quality office accommodation at attractive, affordable rents, with COF's average portfolio rent below $500 a metre. This rental base generally produces lower income volatility than high-end rents, while still providing greater opportunity for future growth. Moving on to slide 6 with a short overview of COF's manager. Centuria Capital Group is an established real estate investment manager that operates on the ASX code CNI. With over $17 billion of assets under management, Centuria Capital Group provides its investors with exposure to quality office, industrial, convenience retail and healthcare real estate investments across Australia and New Zealand, and investment bonds through the Centuria Life business. COF accounts for around 12% of Centuria Capital Group's total assets under management. Slide 7 further highlights the alignment between the broader Centuria business and COF. Advantages of being managed by Centuria is that the group has a 20-year plus successful track record in property funds management and a substantial commercial property platform. With in-house property and facilities management, Centuria provides deep leasing capability and hands-on management of the COF portfolio. The recent merger with Prime West further enhances Centuria's real estate capability, and with now a much larger commercial office portfolio under its management, Centuria offers even greater synergies and opportunity to COF investors. Centuria Capital Group remains COF's largest unit holder with 19.9% of the register and has been a strong supporter in COF's evolution to now be Australia's largest ASX-listed pure-play office REIT that is included in the ASX 300 index. With recent changes in threshold measures, COF is also now positioned for potential inclusion in the FTSE EPRA NAREIT index. Returning to COF specifically on slide 8. COF delivered a strong performance through FY21, completing a record amount of leasing while maintaining high rent collections of over 98%. COF's resilient operating performance generated an FY21 FFO of 19.9 cents per unit, which was at the top end of the guidance range. FY21 distributions of 16.5 cents per unit provided an attractive yield of around 7% at the end of June, and an FFO payout ratio of around 83%. Looking at the results summary in more detail on slide 9. The COF portfolio performed well throughout FY21, generating a COF record level of leasing activity, with leases agreed for around 52,000 square metres, or over 18% of portfolio NLA. This has improved occupancy to 93.1% while maintaining a weighted average lease expiry of 4.3 years. COF enhanced its debt profile through the period with $405 million of debt refinanced in the second half of FY21, increasing the weighted debt maturity to 4.2 years while providing $107 million of undrawn debt. The REIT now has no debt tranche expiring before June 2024 and maintains a competitive all-in debt cost of approximately 2.4%. The COF portfolio is underpinned by high-quality tenants, with around 27% of income coming from Australian state and federal government tenants. Additionally, COF benefits from a relatively young portfolio with an average building age of around 17 years. Younger buildings generally have lower capital expenditure requirements, lower operating costs, and tend to be more attractive to tenants, offering greater building efficiencies and generally better building amenity. Moving back to the FY21 financial results on slide 11. COF produced funds from operations of $102.2 million or 19.9 cents per unit and paid distributions of 16.5 cents per unit in quarterly instalments over FY21. Funds from operations during FY21 benefited from the receipt of a surrender payment from Foxtel, which surrendered its lease across the entire building at 35 Robina Town Centre Drive. Under the agreement, COF received a surrender payment equivalent to the rent payable under the remaining Foxtel lease term, discounted to June 2020. Pleasingly, since the surrender occurred in July 2020, the building has been largely re-let, with occupancy increasing to 88%, which again demonstrates COF's success and focus on active leasing management. COF demonstrated resilience to the continued impact of COVID-19. COF's portfolio rent collection averaged more than 98% for the full year to 30 June 2021. Provided rent relief, both waivers and deferrals totaled around 1.9 million for FY21, with limited rent relief provided during the second half of the year. Turning to capital management on slide 12. As already noted, COF secured a significant $405 million debt refinance, which increases its weighted average debt maturity to 4.2 years, with no debt tranche expiring until June 2024. Our recent debt refinancing maintains COF's competitive 2.4% all-in cost of debt across a diversified pool of 5 lenders. This provides the REIT with sufficient undrawn debt and substantial debt covenant headroom, providing a robust capital structure. The refinancing also signifies strong support from our lenders, who have confidence in the quality of the COF office portfolio. Shifting to slide 14. One of the key benefits of Centuria's management is the strong capabilities of Centuria's in-house asset management team. With a dedicated leasing team, Centuria has consistently maintained high occupancy across all of its listed and unlisted platforms. Since COF listed in 2014, Centuria Management has consistently leased a significant portion of the portfolio year in, year out, maintaining high levels of occupancy each and every year. In FY21, the Centuria team has delivered a record level of leasing in what has been a challenging but improving leasing market. Achieving high portfolio occupancy is a key management focus, and we are actively seeking outcomes to address our current vacancy, particularly at 818 Burke Street, where leasing efforts are progressing but have been impeded by ongoing market lockdowns. Looking forward to the FY22 upcoming expiries, and we confront a much more benign expiry profile than we did 12 months ago, when the forward-looking 12-month expiries were more than double that of the current FY22 upcoming expiries. Moving on to the portfolio on slide 15. COF has a truly geographically diversified portfolio of 22 assets without any single market concentration and exposure to most of Australia's major office markets. Breaking down the record 52,077 square metres of leasing, and COF secured 61 separate lease transactions, representing 18.1% of portfolio NLA. Of the agreed deals, more than 26,000 related to new tenants across 33 separate deals. The balance related to tenant renewals. As a result of this leasing, COF now has a more resilient leasing profile, with more than 63% of the portfolio expiring at or beyond FY25. Detailing some of the leasing success in more detail on slide 16. During the year, COF has completed leasing in virtually every market COF has exposure to. However, in this slide, we will provide some greater detail on the leasing that has been completed across COF's Queensland portfolio. At 100 Brook Street in Fortitude Valley, we leased more than half the building during FY21, which increased occupancy to 100% while extending the WALE to almost 5 years. At the neighbouring 825 Ann Street in Fortitude Valley, we leased about 3,000 square metres, which again increased occupancy to 100%. And on the Gold Coast at 35 Robina Town Centre Drive, we leased almost 8,000 square metres, following the full building surrendered by Foxtel in July 2020. All in all, we leased nearly 16,700 square metres across the COF Queensland portfolio, of which about 14,600 were new tenants attracted to COF's quality assets. What makes this leasing particularly pleasing is that of the new tenants welcomed to the portfolio, 4 were greater than 1,000 square metres. The rhetoric we are hearing across Australian leasing markets is that tenant demand is improving, but has been largely concentrated to the SME and small tenant market. By contrast, COF has been able to attract both small and large tenants, corporate and government alike. Looking at the tenant mix on slide 17. The COF portfolio income is underpinned by diverse, quality tenants, with more than 80% of the portfolio income being derived from government, listed or multinational tenants, with 27% derived from Australian, state and federal government tenants. In addition to the high quality, the COF tenant mix is very diversified, with only the Australian federal government making up more than 5% of portfolio income, and that Australian federal government exposure comprises a number of different departments across multiple buildings. Another aspect of the COF portfolio worth highlighting is the average COF tenant size, as around 72% of portfolio income is derived from tenants of greater than 2,000 square metres. One of the misconceptions about metropolitan and fringe office markets is that they suffer in relation to tenant quality compared to CBD office markets, with the assumption being that they are more reliant on small tenants and small to medium-sized enterprises. This is clearly not the case. Turning to portfolio valuations on slide 15. As of 30 June 2021, 14 of the 22 assets were independently revalued, resulting in an increase in portfolio value of approximately $16.3 million. As a result, COF's NTA, as at 30 June 21, increased from $2.45 to $2.48. The increase in value was primarily a result of leasing success achieved across the portfolio. The weighted average capitalisation rate compressed slightly to 5.81%. Looking into sustainability on slide 19. As is externally managed by Centuria Capital Group, it aligns itself to Centuria's sustainability approach. Throughout FY21, Centuria and COF implemented various ESG initiatives, including drafting Centuria Capital's first sustainability report, which will be released later this year and will include responses to the Task Force on Climate-related Financial Disclosure recommendations. There has been diversification of COF's responsible entity board, with the appointment of Matthew Hardy as independent chair and Nicole Green as independent non-executive director. Other initiatives and sustainability highlights during FY21 are the establishment of Centuria's culture and ESG board committee, the release of Centuria's first modern slavery statement, completing employee and tenant engagement surveys where 94% of employees expressed enjoyment working at Centuria and 91% of tenants recommend Centuria, and retaining Centuria membership to the Diversity Council of Australia. Specific to the environment on slide 20, during the course of FY21, COF sought to enhance energy and water efficiency under the NABERS rating scheme. Furthermore, COF has disclosed its 2019 and 2020 energy consumption, water consumption and greenhouse gas emissions intensity in the appendices of this results presentation. During FY21, we actively sought to enhance COF's energy and water efficiency, delivering improved 2020 NABERS energy ratings and expanding the adoption of renewable energy sources with the rollout of solar projects across the portfolio, such that 26% of assets now produce solar electricity. Testament to the Centuria Facilities Management team, we have seen a reduction in consumption and emissions intensity throughout the portfolio. We are particularly proud of the average NABERS energy rating across the COF portfolio, which is an excellent 4.7 stars. Looking ahead on slide 22. The lead indicators for office demand are positive and has been solid momentum in job creation across a number of office-based industries. Looking at the labour force statistics for June from the AES, and there has been continued job creation across those industries which traditionally consume office space, and we expect this will lead to continued improvement in tenant demand across Australian office markets. Underpinned by significant fiscal and monetary support, there's been strong growth in employment in office demand industries, particularly in New South Wales and Victoria. To an extent, the employment growth is already starting to become evident as a number of Australian office markets demonstrated improved tenant demand in the second half of FY21, as shown in the table on slide 23. What is also telling in this table is the strength of Australia's metropolitan and fringe office markets. While Sydney CBD experienced negative net absorption of 150,000 square metres and Melbourne CBD a negative 187,000 square metres throughout FY21, fringe and metropolitan markets have demonstrated recovering tenant demand and resilient gains. Over the last 6 months, we have seen positive net absorption in many markets COF has exposure to, such as Sydney Fringe, Melbourne Fringe, Brisbane Fringe, West Perth and Canberra, which is in stark contrast to the data generated by the Sydney and Melbourne CBD through the same period. This contrast could be explained by the underlying tenant occupiers, but it could also indicate that businesses are more actively seeking accommodation solutions that enable staff to access workplaces closer to home. Something else to consider when looking at this table is that many of the markets COF has exposure to have relatively low upcoming supply. When coupled with the already significant rental discount of the Sydney CBD, COF's average portfolio rent of less than $500 a metre appears very sustainable, which should generate lower income volatility while still providing greater opportunity for future growth. Turning to the investment market on slide 24. There has been strong investment demand for Australian metropolitan, fringe and regional office assets throughout FY21, and several of these transactions occurred in comparable office markets to COF and have been detailed in the table on slide 24. When this basket of comparable property transactions are collated, it demonstrates very strong demand as investors recognise the relative affordability and accessibility these markets provide to tenants. The average metrics from these sales illustrates strong investor demand for the types of assets COF owns, with many selling on metrics that are stronger than pre-COVID sales, and that are significantly tighter than COF's current valuation metrics. These transactions not only underpin COF's NTA, but suggest there could be positive future valuation implications. Concluding on slide 25. Our focus for COF throughout FY22 and beyond will be to continue generating predictable and quality income streams. We seek to build Australia's leading pure-play office REIT, positioning it to meet changing tenant demands by providing high-quality and affordable office space. Across COF's portfolio, we are encouraged by the leasing activity that Centuria has been able to generate and continue to see across our invested markets. This leasing activity gives us confidence as we proactively address the current vacancy and near-term expiry risk across the COF portfolio. At the beginning of FY21, COF was one of the few REITs to provide distribution guidance despite the effects of COVID-19 prevailing at that time. Notwithstanding the recurring impacts of COVID-19 on operating conditions, it is my pleasure to again provide FY22 distribution guidance of 16.6 cents per unit, equating to a current distribution yield of 6.7%, with an FFO guidance of 18 cents per unit. In making this guidance, we have made a number of allowances for the impacts of COVID lockdowns that are being impacted across our portfolio and the possibility of current lockdowns being extended. As always, this guidance remains subject to unforeseen and material changes in operating conditions. In conclusion, I would like to thank COF unit holders for their continued support. I will now hand back to the operator and invite you to ask any questions that you may have.
Thank you very much. As a reminder, to ask a question, you will need to press star 1 on your telephone and wait for your name to be announced. To withdraw your question, please press the pound hash key. Please stand by while questions queue. Once again, it is star 1. Thank you. We have multiple questions in the queue. Our first question is from Tom Boda from UBS. Please ask your question, Tom.
Good morning, Grant. Thanks for the update. I just wanted to ask a couple of questions around sort of the leasing and just what your expectations are around the capex that you're requiring to spend at 818 Burke, and just where you sort of expect incentives to come in on that one.
Sure. So at 818 Burke Street, we already completed a fair amount of the capex works that are required to reposition that asset. So through FY22, we're probably only tidying up the works that are completing. So in total, on-floor works, we're spending, I think it's about $2 to $3 million on the on-floor works, and we're spending about another $2 million on enhancing building amenity. So I think when we've discussed previously, we've talked about what we're looking at doing in that building. So we're putting in third space on the ground floor, we're reconfiguring the building foyer, and on the rooftop of this building, which is a very large open space that faces onto the Melbourne Harbour and has a northerly aspect, so it is quite different from a lot of Melbourne assets. We are putting exercise equipment, outdoor meeting space, and a lot of other building amenity. In regards to incentives, Obviously, Melbourne, as mentioned on the call, Melbourne CBD has been one of the poorer performing markets across Australian office markets. And we have seen incentives rise in that market. So at this stage, we are forecasting that we'll be paying incentives probably in the mid-30s%. But given the amount of work we're doing to the portfolio or to that building, we think that we'll be able to do better than the prevailing market in regards to being able to attract tenants and get an incentive rate.
Okay, thanks. And then for the Robina asset, where the leasing was good, sort of to see that progress come through. But I do know there's a pretty material expiry in 22, and from memory, you kind of got a short-term deal away there that could be extended for a few years. I was wondering if you could update the progress on that potential extension, if that is that 56% that's in the expiry chart for that asset.
Yes, sure. So just to provide a bit of detail on that, so it's 3 floors of that building have been leased to Centuria, and that totals in excess of about 4,500 square metres. Centuria is a call centre operator, and they have a number of contracts backed by Australian corporates and government agencies. Now, the way that those call centre contracts go, there is an initial, I suppose, testing period or trial period, and following that, they get a longer-term commitment. So we've sought to mirror the lease commitment to that. So Centuria have taken an initial 6-month term that expires 31 December of this year, and then following that, there is a 3-year option. So that 3-year option will have to be exercised during the course of that initial term. At this stage, Centuria are on the floor. They're operating at almost full capacity, and they're indicating to us that everything is going to plan. So we are making the assumption, well, I think it's a fair assumption that they will stay. But in making guidance for FY 22, we have assumed there is 6 months downtime following that expiry at 31 December. So if they do renew, which is what we think will occur at this stage, there will be upside to the FY 21 FFO. FY 22, sorry. FFO.
Can you quantify that upside in, given that there's a good chance they stay, can you just sort of quantify that in sort of FFO per share? Just the 6 months on that.
Yeah, look, it's probably going to be in the realms of 1 to 1.5 million, which is between 0.2 and 0.3 cents per unit.
Okay, thanks.
Our next telephone question is from Lauren Berry from Morgan Stanley. Please ask your question, Lauren.
Yeah, good morning, Grant. Just if we can go back to the guidance, are you able to give a little bit more colour around what you are assuming in terms of your occupancy throughout the year, and also any rent relief that you might have to provide to tenants?
Yeah, so we're certainly making assumptions at the moment for ongoing COVID relief. Those assumptions are probably consistent with what we've had to provide through FY 21 and the back half of FY 20. So we are certainly making assumptions on that. In regards to leasing assumptions, given current circumstances, we haven't been overly optimistic in terms of our earnings guidance, in terms of being able to lease that space. So most prominently, 818 Bourke Street, we haven't factored very little income into the FY 22 guidance. At this stage, I have full confidence we'll be able to address the 818 Bourke Street vacancy during the course of FY 22, but I still don't think that we'll be able to get too much income into FY 22 from that vacancy. So we have taken a reasonably conservative view on forecasting, simply because of the circumstances we find ourselves in at the moment.
Okay, cool. And just on the DPS that you've set, can you just give us a sense of how you set that amount? Like, is this covering AFFO or any of the capex that you're doing on your various assets this year? And I guess, how should we think about the payout ratio going forward?
Yeah, so the payout ratio that we're looking to get probably over the longer term payout ratio between 85 and 90% of FFO. So when we're thinking about that, we are thinking that the payout ratio, or what is withheld, will cover maintenance capex and the incentive component of fit-out contributions over the longer term. Now, while COF is becoming a much larger portfolio, we do have some larger tenancies within that, so there is going to be some bumps in regards to incentives that are paid over the period. So we are looking for a averaged incentive amount. So that's probably what we're looking to cover. And as a maintenance capex guidance, given we have got a relatively young portfolio, we sort of assume that maintenance capex over the longer term will be around that sort of 30 to 40 bips of portfolio value.
Does the extra work that you're doing on energy and water efficiency at the moment contribute more to capex at the moment?
So the way we look at that type of work, so a lot of that work actually has a positive payback period. So they are actually beneficial to FFO in some respects. So particularly if you've got a gross building and you're getting a payback of less than 5 years, that is almost immediately earnings accretive by undertaking those works. In addition to that, a lot of the work that we are doing within energy improvement is management. So we do a lot of monitoring and trying to get as much out of the assets as we possibly can without having to incur further capital expenditure.
Okay, great. And then just final one from me. Are you able to talk a bit more about the leasing you've done in the period? You've had a big half of activity. Can you just talk about, whether tenants are upsizing or downsizing, the average tenor of the leases that are being signed again?
Yeah, sure. So outside of the concentric short-term lease that we did at Robina, we did lease terms ranging from probably 3 to 10 years. So it was pretty consistent with what we were doing pre-COVID. So I wouldn't say there's been a material change in that. Of the larger tenants that we dealt with, so tenants are greater than 1,000 square metres, the average tenor was probably generally between 5 and 7 years, which again is pretty consistent with what we were doing pre-COVID. So I don't think there's been a material change in duration of leases or at least term. I know 12 months ago there was probably more evidence of tenants taking short-term extensions, but I think that uncertainty is dissipating and tenants are now looking at their future accommodation requirements in a more normal fashion. In terms of tenants expanding or contracting, we haven't really seen a material change across our portfolio. So we haven't really seen any of our tenants seeking to extend their lease and materially contract or expand for that matter. So at the moment, I think it is more a process of shuffling deck chairs. We haven't really seen material expansion or contraction either way at this point.
Cool. Thanks, guys.
Once again, it is star one. Our next telephone question is from Sholto Maconochie from Jefferies. Please ask your question.
Yeah, hi, Brian and team. Thanks. A lot have been answered, but I'll just sort of follow on from Lauren and Tom. Just on the COVID impact, obviously you've only got 25% in New South Wales. You provided around 2 million of assistance in 21. Is that the sort of broadly similar level you're going to provide this year, you think, in your guidance?
Look, it would be consistent. Like as mentioned, I'd certainly hope we don't have to provide the same level of relief through FY22, but at this stage, that is what we're forecasting.
Great, thanks. And then just on the leasing, thanks for clarifying the Robina asset before. I noticed you've had some, obviously Burke Street's a bit slow. Richmond looks like it increased, you had a bit more vacancy increase there in Richmond. Is that it's an extra expiry or just, and how's that going to lease up?
Yeah, so in that particular building, we've reset all the existing tenants within that building. So the two main tenants within that building were previously Forever New and GE. GE had sublet the vast majority of their tenants following the sale of GE Money some years ago. So one of the tenants was Harris Scar, which unfortunately was no longer a subtenant after going into administration, and they had another small subtenant, which we have now converted to a direct lease. So we have reset all the existing leases within that building, but as a result of Harris Scar going into administration, that space has become vacant. So that space is now back on the market for lease. In that precinct, there has been a number of leases signed. There is a lot of activity occurring. So as everyone on the call is probably aware, Growth Point have leased the majority of their building. Garda are getting some leasing traction on theirs. How our building differs is that we have got an existing fit-out in place. And what we're seeing almost universally across Australia at the moment is that tenants are gravitating towards space that has got an existing fit-out in place. So we are pretty confident that we will be able to get that space away in due course.
And then just on the leasing, obviously some upside if they take that option at Robina. But on the balance sheet, you've obviously got strong comps supporting your NTA growth and cap rate compression on those comp sales. So it's probably upside there. How do you look at acquisitions? You're gearing sort of at the midpoint, towards the high end, 33 of your guidance. Would you be looking to acquire assets, and how do you think about that with the balance sheet? You're sort of trading at NTA now, so what's your sort of view on capital management and acquisitions, given where assets are trading and where your gearing is?
Yeah, look, I think, if we can find assets that we think that complement the COF strategy and existing portfolio, then that is something that we will contemplate. Obviously, where we're trading today gives us the opportunity to give that some consideration, so that is something that we would look at. But I think it's a point you raised that there is still a disconnect between where the direct market is and where the listed market is. We've seen very strong demand for assets that are comparable to COF right across Australia in regional, fringe and metro markets. And a lot of those sales are selling on metrics that are very strong, stronger than pre-COVID pricing. So the metrics that we're seeing absolutely reinforce where COF NTA is. And as mentioned on the call, you could extrapolate from that there could be future valuation upside. So I think that is certainly something worth looking at. These are not one or two isolated sales. I think we've got a table in there of 20 or 20 plus sales. So this has been, there's been a lot of activity and a lot of strength in the direct market. And investors are certainly looking towards the markets that COF invest into as the preferable Australian office markets at this point.
Yeah, and then just finally, the leasing was really strong. If you look at the new leasing in the second half, at almost 16,000 metres, quite a lot higher. That's in the new leasing. That was very high. What sort of tenants were they? And were any moving from CBD, or is it just a broad mix of tenant types?
So in Brisbane, the new tenants that we attracted to Fortitude Valley, some were CBD tenants, others were existing fringe tenants. We did a lot of leasing in Adelaide, so 131 Grenfell Street was practically vacant at the start of calendar year 21, and we have attracted a state government tenant to that building. And at 1 Richmond Road, we had 3,500 square metres expiring. I think when we last reported, and we have leased or renewed a tenant over one floor, which was about 700 metres, and then we've attracted another 700 metre tenant to that location, and they were an existing fringe tenant that's expanding.
All right. Great. Thanks, Grant, and thanks for providing guidance for 22.
Thanks, Sholto.
And our next telephone question is from Mr. Andrew McFarlane from Jarden. Please ask your question.
Oh, hi, guys. Just a quick one from me. You mentioned earlier on the call just in terms of synergies from the Prime West acquisition. Just wondering if you've sort of thought through what those synergies could look like, more broadly across the business, whether asset management or even whether from an acquisition perspective, is it, potentially give you a better cost of capital to go and do things within the market as well?
Look, yeah, I think that the Prime West merger is still relatively new. And the synergies I was probably referring to at the moment is more a people capital basis, in that we now have a lot more staff working in the broader Centuria team, and we've got effectively a dedicated team in Perth, which we never had before. So I think that provides certainly better knowledge base than what we had previously, and I think collectively Centuria now has a much deeper real estate capability than we had before that. The other element, obviously, is with a larger portfolio, we're going to get economies of scale on things like, which will benefit outgoings, things like buying power for electricity, buying power for soft services contracts and things like that. So that's probably the synergies that I was thinking of initially. As to in terms of what happens from there in regards to opportunities beyond that, I think it's probably too early to tell.
No problem. Thanks, guys.
Once again, if you wish to ask a question, it is star one. There is no further questions at this time. I'd like to hand the call back to the speakers for closing remarks. Please continue.
Well, I thank everyone today for joining the call. If anyone's got any further questions, please feel free to reach out to either me directly or to Tim Mitchell. And otherwise, have a good day.
That does conclude the conference call for today. Thank you for all participating. You may all disconnect. Goodbye.